watching Stockwatch. I'm Zinati Guma, and joining me to unpack your stock-related questions today are Alex Duys from Umthombo Wealth and David Shapiro from Sasfin Securities. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X @BusinessDayTV using the hashtag Stockwatch. I don't know what's happening in the markets. It seems the JSE is in the green, mixed picture in the US, mixed picture also in Europe. David, are the markets at this point just struggling for direction, but have they stabilized? What exactly is the sentiment here?
Yeah, it's a nervous week. We started off on Monday. Last Friday, we were all celebrating, went to bed on Friday. Very happy that the S&P was at a new high. Wake up Monday morning and everything's changed because of deep sea. And and I've used this word so many times, not me, but everybody. Markets are rattled. Okay, yeah. This is going to happen. In fact, even now, as I see the headlines, Alibaba's come out with an even better model. So this is going to happen. More and more models are going to come out. And the more, the better. It just makes it cheaper and it makes it easier for everybody to use. So that was the one thing. Now we've got the Fed. No one expects anything coming out the Fed. But if you look at outlook for the reduction of US rates, some analysts are saying 100 points, which is 1%. So others are saying nothing, or maybe 1. So you've got all, and then we've got results. We've got Tesla, we've got Microsoft, and we've got Meta all coming out. So everybody's edgy and nervous. So I think that explains why it's so difficult to read what's happening.
Yeah, it's quite interesting what David says, that now Alibaba comes out with an even better model. And someone that I spoke to earlier on was talking about this kind of copycat situation where all of them are kind of copying each other and then doing better than the last one. Alex, is this just emphasizing that AI is the place to be, but maybe now it's just going to be more difficult to find out who are the actual winners in that space?
Yes, exactly. So I think AI is pretty much the modern space race we're seeing at the moment here. Main differences is predominantly between the US and China. So yes, I think the advances we're going to see in AI is we cannot even comprehend what we're going to see in the foreseeable future. So the pace of growth is going to be phenomenal. I do think there will be some form of regulation specifically on US citizens being able to use, for example, Chinese AI. I don't think they will be allowed to do that. And there'll be huge investments, obviously, from the US perspective. And I think this will also be a kick on the backside for the US to realize that, listen, they are not as far ahead as they thought. And I think, just if you think about US historically and their pride and so forth, they are going to start really working double down. And as a result, I expect the pace of innovation to be faster than it was.
All right. Well, gents, let us get into the questions because there are lots of company results.
Laughing is that the space race, and I think Alex was referring to Sputnik. I think that's been great because and that was long before you were even born. I don't even think Alex was around, but I remember Sputnik.
I was at 56, 57, somewhere there. Yeah, certainly not.
and no one could believe they put the satellite, and then they were the first with Yuri Gagarin, who was the first man, and America was absolutely shaken and shattered by this. And as Alex said, it spurred on massive investment, massive innovation, which eventually led to the first man on the moon, which was only in 1969. So, this could happen. I think America have taken a little bit of a knock and say, okay, we can't rest on our laurels. Even NVIDIA, we've got to get even better chips, cheaper, less power and everything. So it's going to be a lot of fun.
All right. Well, we're talking about cheaper chips, but going on to something that isn't cheap, and that is luxury. There is a question here on LVMH and Richemont. I have 2 questions on 2 shares I want to short. Is the Richemont a short at 3,600 a share? And then there is, actually, you know what, before we get into LVMH, let us start off with Richemont. They came out with very, very shiny numbers. What was it, a week ago, 2 weeks ago? And I'm wondering why there would be a thought of shorting it at this point, David.
At your peril, at your peril, short it. Everybody's wanted to short it for the last 15, 20 years, ever since it was unbundled from Remgro. I think it's even more than that. Don't do that. Luxury can get you, and this is what got everybody. Look, their results weren't staggering, but they weren't bad. And I think what happened is that they weren't as bad as everyone expected. And if you look at the jewelry side, it was really very encouraging. And that actually led to a upward run in luxury, from Richemont to LVMH to Kering to Montclair, all those numbers, and then, sorry, we also had good results coming out of Burberry,
Yes.
which were also not as bad as the market was expected. They weren't astonishing, but even with LVMH's results, so I think that's spurred on a demand for luxury. It doesn't say everything's great. There's still, we're in a very subdued economic environment, but it's not as bad as everyone expected. And that's why you got this massive run in Richemont. And watch sales, which haven't led the way up, which have been under pressure, were actually very encouraging.
Yeah. I mean, so the viewer goes on to say the luxury sector seems to remain under pressure and hence a short. It also goes to the LVMH results that were out. I saw that sales were better than expected, but clearly there's some concern that investors have. Alex, what's your take on the luxury market?
I mean, firstly, on Richemont, I mean, they actually did quite well. If you exclude China, most of the region's revenue in constant currency was up the region of 19-20%. And instead of a net cash position of 7.9 billion euros, and the valuation, I would say, is probably fair to slightly above fair, but certainly not hellishly expensive that you would like to think you would like to short it. So I concur there with David. Be very careful. Momentum is behind the stock there. I don't really follow LMUH that closely, but if you look at this update, obviously the revenue number was quite weak. And as a result, massive negative operating leverage, earnings down about 17%. And the valuation does look a little bit high, even higher than Richemont, but yet doesn't give the same growth at this particular moment. So I would say be cautious there, but not necessarily shorting it. But I wouldn't be surprised if you do see some broker downgrades on LMUH post this update.
Yeah, I mean, David, what was actually the pressure point for LVMH here? I mean, this is one that was the bellwether of the luxury market.
In fact, it was their watches and jewelry, which was where Richemont was stronger. So you can't really read the market. China is not as bad as everybody thinks. And, we're hoping for a turnaround in spending globally. We're all hoping rates come down, people start to spend a little bit more, travel. There has been a lot of travel. So it's not easy to read the market, but, their leather and apparel is still very, very strong. So it's kind of a patchy result. I thought it was better than expected, but the market marked them down about 4 or 5% today. But look, on the year, they're up 12, 13%. I think even more than that. I'm not sure where it is, but in a market which hasn't done much in a year, we're only 3 weeks into it, 4 weeks. It's okay, and I don't short it. Don't short these businesses. It's unless you're expecting a massive kind of recession, depression, or something like this. The rich can spend, and you go to Hermes or something like that. Yeah. And or Ferrari, they come out with a new model. That model's gone.
Yeah.
It's not for us. It's not at our level of expenditure, and that's why luxury kind of sometimes is bulletproof.
No, this viewer badly wants to go on a shorting spree. They're also asking about Harmony Gold at 205 right now. Is it a short? Gold price is struggling to move over 2,800 an ounce, yet the share price has rallied hard in January. Also, every time the price gets over 200, it drops back well below 180. Shorting gold at this point, Alex?
Look, if the viewer can forecast what's going to happen to gold, that can determine this decision, right? So if gold prices hold or increases from here, it's definitely not a short. If anything, its spot earnings yield is still very attractive. So you really need to believe that gold is going to have a material pullback. So what could impact that potentially is obviously geopolitical risks, but we're seeing perhaps the worst of that for the time being coming down. And of course, the fiscal issues in the US and everywhere, and that's not going away. If anything, it's going to get worse. So that probably will mean there will be a de facto buy of gold, specifically central governments and so forth. So it's very difficult to forecast gold in any time. But I would be very, very cautious to say that there's going to be a big pullback and looking to short stocks.
Yeah, and there's really no pullback. Today, Harmony Gold is up 4%. David?
The gold share is strong. You can't, I'm not a gold bull. I never have been. But you can't deny the performance. You can't deny that gold is going up. Central banks are buying it for whatever reason. And it's likely to stay there. And as long as gold is up there, the rand is where it is, these miners will do well. And Harmony's the only real South African mine, even though it's got other mines outside of South Africa. I mean, Goldfields, Anglos don't exist in South Africa anymore. So, and it surprised us on the upside. The results have been spectacular. So why be silly? Go find something else to short. I don't know. If you feel this absolute compulsion to go short, try platinum.
Yeah.
You'll also get taken out. You'll also, it's also trying to find a bottom there.
Yeah.
It can be very costly.
Yeah. There is a question on an S&P 500 ETF. Your view on the ETF at 10x. 10x is S&P 500 for long-term investment as a buy. So yeah, I'd be guessing just any, I guess, S&P 500 ETF. Alex, considering what has happened, how would you be navigating that?
Sure. Look, it's a difficult one. So let's try to do a pro and a con aspect to it. So pro side of things, you could argue that the market deserves a higher rating than historically because of the high free cash flow margins that the Magnificent Seven produces compared to history, and the fact that they've got this enormous growth potential still behind the AI theme, for example. So as a result, you still probably expect good earnings growth from the S&P 500. On top of that, the next 4 years, we've got a Donald Trump presidency, and we know one of his scorecards is the stock market. So he'll probably try to pull all levers that he possibly can to try to keep the stock market high. So that could be, let's call it the bull case. Bear case is that equity risk premium is pretty much close to zero. So that puts it at quite expensive, specifically relative to some of the treasuries, and that the valuations are, I would say, probably at a standard deviation above historical means, as well as net margins being quite high. So argument could be made that there will be a bit of a reversal in net margins over time, and then as a result, a high multiple cannot be sustained. So it's very, very difficult to see where it's going to go. It depends on your views on those factors I just mentioned there.
Yeah.
But I would say in the short, the momentum is probably still with the US. It's still the excellence of the United States is continuing, and considering that other markets like Europe and so forth are lagging so far behind, I think capital will continue to flow to the US, which will probably be good for S&P 500.
Yeah, I mean, talking about, I guess, a bear case here, David, does the concentration of the S&P 500 not spur up any kind of concern when you hold an ETF like that?
Not really. I'm not that. It's not going to be a great year. It's not going to be 23 or 24. We're not going to get plus 20%. And I can live with 10%. I know we've become very greedy. We want 20%. We want these high yields. It's not going to happen. I think the market is going to broaden out. I think it's going to be a year in which tech earnings are good, but they will give up some of the PE. In other words, I think earnings will catch up with share price. So, that's okay. That happens in markets and that. So, if I look at consensus views on the S&P, it can be anything from 6,600 to 7,000, 7,500. I think I'll take the lower level. I'll be happy if we make 6,600, which is good 10% up from where we are at the level, and that's fine. That's better than you can get in a bond, in a US bond, where the 10-year is what 4.5 or so. There's a good margin of safety there. So don't be greedy. That's so it'll be a good. I don't foresee any major issues in that. We don't know what Trump's going to do. We don't know what's going to happen geopolitically. But I think it's going to be a year where rates do come down in the United States, and growth does pick up. And so I'll go for a 10% increase plus, maybe 1 or 2 points further than that.
Yeah, all right. We're talking about catching up. Mondi has a lot of catching up to do, especially when it comes to SAPI, looking at SAPI's performance. So Mondi shares are not really performing well during the last 6 months. Is it time to sell? Let's actually start off with that, Alex.
Yeah, I don't think it's time to sell. I think they're pretty much close to the bottom from an earnings perspective. So this next set of results will probably reflect the bottom. And then you probably would see a bit of a recovery, specifically in the corrugated margins going forward. Last time I checked, dividend yields in the region of 5%, free cash flow yield over 8%. Those are good metrics for Mondi, right? So, Mondi is not that type of business that will give you high growth rates in euro terms, but certainly can grow in single digits, call it over sustainable periods of time. But from this base, we actually anticipate a bit stronger than that, perhaps double-digit growth rates. So with a 5% dividend yield, that's certainly nothing to sneeze at. So I think Mondi, for me, for the first time in a number of years, is starting to look relatively interesting. So I would probably be more of a buyer than a seller.
Okay. Well, the second part of that question is, if the viewer does decide to sell, can you recommend a replacement share that might grow and pay reasonable dividends, please? I want to actually ask, if he's selling, can he buy SAPI? Would it be a good thing to go and buy SAPI, David?
SAPI, we never know from one quarter to the next what surprises we're going to see. If it's not, sales are down, they can't raise their price, debt goes up, costs are up. It's a very difficult, it's just one of these companies that can never get a sustainable growth. If you want to punish yourself, buy SAPI. And I think Mondi as well. I don't disagree with Alex that you're probably at the low, but we've been waiting. Every year we're waiting, every year. And it's not an easy industry because you're not producing a product where there's no competition, so they can push price increases through sometimes, not always, demand sometimes fall. We all thought with e-commerce that this was going to be a runaway company. They produce the boxes. Not so. So I don't know. I've become very impatient with Mondi and probably say, okay, not cut the losses. Let's try to find something else. But that's also not an easy decision in the South African market. To find a replacement that's going to give you the kind of growth that you want. It's not easy.
Okay, let's go into banking. Talking about patience, a lot of people have been waiting for Absa to kind of catch up to the other banks. What do you expect Absa to do in their next results that will come out soon? Is there a turnaround in the stock price, Alex?
We think Absa valuation is relatively compelling and offers a very good risk-reward profile in our view. So a lot of negativity and poor performance is, in our view, priced into Absa.
Okay.
So if they do give a slightly better result or outlook, I think the market will react favorably to it, like we saw in December last year. So I think there is certainly, and South African fund managers are looking to buy Absa. I mean, I've seen a lot of fund managers speak out in the quarterly reports as one of the top ideas and so forth. So I think there is a lot of investors are willing to buy it if they get momentum. They've obviously underperformed materially compared to some of the South African banks over a 6-month, 1-year period. So there's some catch-up trade you could argue. They do have some reasons, of course, for trading where they have been. I mean, management issues has been a big problem. They have underperformed operationally. Bad debts have spiked. So there's a lot of negativity as I alluded to. But I think we're certainly quite optimistic at the moment. And we think you need to buy before the fact, because the share might rally very strongly if there's a good update.
Yeah, and actually, bad debts being one of the main concerns that people have had with ABSA. But I mean, the interest rate cycle has turned. David, do you think that there could be significant upside from that for ABSA?
That's my worry. We're getting very carried away with 1.5% growth, which is hardly growth at all. And one of the problems that we're starting to see, in fact, if you looked at retailers are not doing what we thought they would do. They're under a lot of pressure. We had a great year last year coming under pressure. And I'm a little concerned that this economy hasn't got the momentum that we would like. It's not being provided, there doesn't seem to be any major growth area. And banks are great. They're solid. I can't fault the way that they are run. They're never under pressure. They manage their books very well, but they also don't lend out that much. And when I look at when you look at tomorrow, hopefully there's going to be a 0.25% rate. To borrow at 11+%, no business can survive. It's just too expensive to function in with those rates. Yes, admittedly, if you've got a lot of money, you'll get a cheaper rate. If you haven't got money, you're going to pay more. So I still think there's pressure on this economy, and ABSA and the banks are just going to bumble along, but they're solid. You'll get a decent dividend yield, but you're not going to get into high growth areas here. Unless there's catch up. Okay. We saw catch up last year with Nedbank and ABSA, whereas Standard Bank and First Rand and Investec just kind of fell behind.
Okay. Gents, one last question before we go to your stock picks. DataTech. Is DataTech fully priced, or does it still have some way to run? It has actually been running a lot. Seems that there's nothing really trying to stop it at this point. Alex, your take on DataTech?
Look, I mean, DataTech is extremely difficult business to forecast because it's got very high operational leverage, meaning it's got very low EBIT margins. So small change in revenue can have a big impact on a bottom line. So what they're trying to do is, obviously, it's been a self-help story. They've been selling some assets and they've created a lot of value through that. That is why the share price has been strong. But at the same time, they are trying to increase the gross margins as well as the EBITDA margin expansion. And that creates lots of free cash flow and so forth. And they're still trading at an enormous discount to some of the international peers for good reason. But if the margins expand, free cash flow improves, you could make an argument that that gap could narrow. And I've looked at some consensus estimates for DataTech recently, and I was surprised to see how aggressive they are. So yes, they're also going to be slightly backwards in the next update, but post that, with the expansion in margins I'm alluding to, there's a strong expectation that they can execute on that. If they can do that, then the stock looks cheap, yes. But DataTech is a company that has historically underperformed expectations.
Okay.
But in recent times, they seem to have pivoted and making strives to actually unlock value for shareholders. So, interesting one.
David, do you think that it could come out with more steam?
We've been waiting since 1987 for this company to perform. That's how long it's been around. They're box droppers. In other words, they haven't got any unique IT. What could you say? There's nothing special about what they do, and I think that makes it very difficult. And I think, as Alex said, you've got very low margins there. You need, sales. They've got the leverage on that point. But I don't know. I haven't watched this company closely since 1987 or something. When they listed with data. So it's, I'm not quite sure what they do anymore. But there could be value in those kind of companies if you do the research and you do the in-depth analysis like Alex has done. You can find those pockets of value, but it hasn't got market appeal. It's just, I think mainly through neglect and through the fact that it hasn't been followed or marketed.
David, you and your historical references, you think a company is doing well this year relative to 2 years ago, but then you come out with 1987 performance.
Yeah, I think Jens Montanon has been around since then. We knew it very well. It was one of, in those days, that was defined by computer companies. 87 boom was a big computer boom. But relative today, I mean, it's totally different. I don't think they've changed their model. I don't know. I think I might even have some equipment on my desk that comes from there.
Okay, Jess, let's get to your stock picks for today. Alex, what are you choosing?
Yeah, so I'm going for Renet. So we saw the announcement recently that they've exited British American Tobacco. So that leaves them with about 26% cash at the moment. So that does introduce some, I guess, capital allocation risk. But I do think also, they've got some interesting options about. So they've got, of course, Pension Investment Corp, which is a great asset. I think that asset is materially undervalued and in the future could be listed and create value. It's unlikely they could buy because then they'll have to change the structure, but that's something to think about. But I think there's some corporate action here. Stock is certainly cheap. It's discount to NAV is a region of 37%, while 26% of the NAV is cash. So you know what the value of that is with Pension Corp. So I think there is a value unlock opportunity here. And we just need to trust that Rupert's and the rest of the board will make the right decisions. So I'm cautiously optimistic on Renet.
All right. David, what are you choosing?
I'd go for my favorite company, ASML, who came out with numbers today, which were ahead of market forecasts and also point to the fact that there is a demand for their very sophisticated machines. They've made some very decent forecasts of what sales are going to be this year, very steady. And I just think that this is going to continue. I'm a big, AI junkie. And this is pivotal to the success of artificial intelligence and, for any kind of processing. So, yeah, they admit that it's only AI driving, the other areas that are under a bit of pressure, but super business, and it's not in Silicon Valley, it's in the Netherlands.
All right. Well, thanks so much for your time and for your analysis today, gents. That is all for tonight's Stock Watch. Thanks to our guests, Alex Duys from Umthombo Wealth and David Shapiro from Sasfin Securities. Up next, The Close. Stay with us.